Hello everyone, welcome to Alvefino's YouTube channel. Our first video today will be about the basics of futures and options in the stock market. I know many of you are confused, and I hope all of your doubts will be cleared today. So, futures and options, or just FNO, are essentially derivatives. So, what are derivatives? Derivatives are financial instruments that don't have any value of their own, but instead they derive their value from an underlying asset, such as stocks, indexes, bonds, or commodities. So, a future is actually just a contract that obligates both sides of the party to buy and sell the underlying asset at a fixed predetermined price and date. In theory, at the expiry of the contract, the buyer and seller must exchange the underlying asset at that locked in price. But why do we need these contracts in the first place? For hedging and for speculation. The main reason futures came into existence was actually for hedging purposes. So, for example, let us assume that you're heavily invested into Nifty 50 index because you're certain that in a longer period of time the stock prices are going to increase. But you're unsure if that is the case in the near future. So, to protect your capital, you can hedge your portfolio by short selling a Nifty 50 future contract. So, in the event that the Nifty index crashes, your losses will be made back in the short position of the future. So, in a very similar manner, many large portfolios are hedged to protect themselves from price swings that can erode their capital. But most of the retail traders like us use futures for speculative purposes. That means, for example, you're thinking that Reliance stock is going to go up, and for the sole reason of making profit out of this speculation, you will buy a Reliance futures contract. Now, let us assume that after a couple of days you were correct and you want to book your profits. The most common way to do this is to just do the opposite action, so selling your contract that you have bought previously in this instance. If you were in a short position, you would just buy back the contract to nullify the agreement. So in this whole process, there are no underlying shares changing hands. You are simply taking positions on a contract. So now you might wonder, why would you do this through futures when you can achieve the same profit with doing stocks as well? So the two main reasons, margin and short selling. Now these are some terms you will always hear in the futures market. A margin money is the amount you must pay to either go long or go short on a contract. The margin amount for futures is much lesser than the original amount needed if you were to take the same position in the underlying asset like a stock. All of the future trading happens in lots, which is just a number of the underlying asset grouped, which means you can transact only in multiples of lots with a minimum of one lot. If you think the prices will go down in the future, you can also make money by simply short selling a future contract, which means you will be obligated to buy back the contract at a future date, regardless of the price. So if the price of the underlying really does go down, you can just buy back the contract and the difference would be your profit. Like most contracts, a future contract also has an expiry date, which is the date at which settlement of the underlying asset happens. Let us take a look at an example involving all the future concepts we just learned. So the future price of Reliance is 2400 per contract, and the lot size is 250, and that means one lot would cost you 250 into 2400 rupees, which is 6 lakh rupees. So let's say, for example, you want to short sell Reliance now. Remember, you are not selling any shares, you're just taking a position on the contract. You would just need the margin money of about 1.4 lakh. So this is the money that a buyer or a seller that has to just put forward at first. And usually this margin money is calculated as a percentage of the total contract size. Now, after a couple of days, Reliance future is trading at 2300 rupees and you want to close your position. Then you would buy back the contract at 2300. So your profit would be 100 into 250, which is the lot size, which is equal to 25,000 rupees. As you can see, the return on investment is much higher since the investment is just the margin money. So I hope this video was informative, and that's it for today. I will be meeting you in another video, so please subscribe to our channel for quick updates.